Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories within corporate documents, and today we're diving into a report that might leave you scratching your head if you aren't paying close attention to the details. This report from Oakwoods Acquisition Corporation is a bit different. It is not about their profits or losses from last quarter in the usual sense. Instead, it tells us about a crucial decision they made regarding their timeline to find and merge with another company, which is what these special types of companies called Special Purpose Acquisition Companies, or SPACs, are set up to do. Oakwoods Acquisition Corporation is a company that went public with the specific goal of raising money to buy another existing business. They are what we call a Special Purpose Acquisition Company, or SPAC. They don't have any actual business operations of their own. Their whole purpose is to find a target company and combine with it. They usually have a limited time to do this. This particular report, filed on the 21st of October 2025, is all about an extension to that deadline. Think of it like this: they had a certain amount of time to find a business to merge with, and they needed more time. Before we get into the extension itself, let's quickly touch on what kind of shares this company has. They offer units which are like a package deal. Each unit comes with one Class A ordinary share, a right, and a redeemable warrant. These are all different pieces of ownership or future ownership in the company. Their stock trades under the tickers OKU OKU OKU, and OKU on the markets, specifically on the Nasdaq. Oakwoods Acquisition Corporation is an emerging growth company. This means they are a relatively new public company and qualify for certain relaxed reporting requirements compared to much older, larger companies. This is pretty common for SPACs. So here is the main story. On the 8th of October 2025, the shareholders of Oakwoods Acquisition Corporation voted. What did they vote on? They voted to give the company more time to find that business to merge with. Originally, they had a deadline, but this vote essentially extended it. They can now take until the 28th of March 2026 to complete their business combination, which is their main goal as a SPAC. Now, this extension isn't free. There is a condition. Their sponsor, which is basically an early investor or the founding group of the SPAC, has to put more money into a special trust account. In this case, it is a specific amount just under $43,000 for each one. Month extension, this money is essentially to keep the SPAC going while they search. It signals that the sponsor is still committed to finding a deal. This report tells us that the sponsor had already deposited extension fees for September, which extended their deadline slightly to the 28th of October 2025. This current filing is about securing those longer-term extensions based on the shareholders' vote. This extension is actually the first of up to 6 one-month extensions they can take after that shareholder vote, so they have a lot of runway to find a deal. Each of these extensions costs money from the sponsor, as we mentioned. This falls under the Other Events section of the report, which is where companies disclose significant new information that isn't necessarily covered by other specific sections. The report also lists exhibits like the minutes from the shareholders' meeting where this extension was approved. This is like the official record of why they got more time. And finally, the report is signed by Lixin Zheng, the Chief Executive Officer of Oakwoods Acquisition Corporation. Now, let's look at this from a more analytical perspective, like Warren Buffett might. For a SPAC, the main metric to watch isn't revenue or profit because they don't have operations. Instead, it is about their ability to execute their primary objective, finding and closing a business combination. The key things to consider here are the timeline, the management's commitment, and their ability to find a good deal. The fact that they needed to extend the deadline isn't necessarily a bad sign in itself. It is common for SPACs to use these extensions. The crucial element is the sponsor's willingness to keep putting money in for these extensions. That $42,998.37 per M-onth shows a commitment from the sponsor that they aren't giving up on finding a deal. On the flip side, a long search can also mean it is a tough market to find a suitable target, or that the SPAC is being very selective, which can be good. But if they go through all 6 extensions without finding a deal, the SPAC will likely wind down, and the money in trust would be returned to shareholders. The key risk here is opportunity cost for the sponsors and shareholders if they don't find a good deal within the extended time frame. The market for SPACs has been quite volatile. Many SPACs raised a lot of money in recent years, and now they are in a race against time to find companies that are good investment opportunities, and that will also be attractive to public investors after the merger. The success of Oakwoods Acquisition Corporation will entirely depend on the quality of the company they eventually merge with. Looking at the broader picture, this filing is less about the current financial health of Oakwoods Acquisition Corporation and more about their strategic runway. They have successfully secured more time, signaling continued belief from their sponsors and shareholders that a suitable merger target will be identified. The real financials will come into play only after the business combination is completed. So, in conclusion, Oakwoods Acquisition Corporation is buying time. They have extended their deadline to merge with another company until March 2026, with the sponsor footing the bill for these extensions. It is a waiting game for this SPAC, and their future success hinges entirely on the deal they will eventually strike. Keep an eye on their next filings to see if they announce a merger target. Alright, that is our quick decode of this Oakwoods Acquisition Corporation filing. What is your take on SPACs and their extended timelines? And do you think they will find a deal? Drop your thoughts in the comments below. If this breakdown was helpful, please hit that like button and subscribe for more in-depth corporate analysis. And don't forget to join our Discord community, linked in the description for more discussions. Thanks for watching and see you next time on Corporate Decoder.